The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Now here's another example. We have the US dollar against the Swiss franc, and what we have, of course, is price consolidation. Then we have the signal, what we need, the bull break candle buy market. And again, totally subjectively, we could think, well, how do we manage this position? You know, what do we do to trade this? We're not privy to this price action that's going to unfold, but let's manage this trade as you would any other trade. First thing we need to do is, of course, decide well, if we're buying the market at that price, we get the signal with the close above the technical structure. Where do we place our stop loss? So given that you're looking for the signal, i.e. the signal is, of course, the market structure itself, then what we'll look to do is say, well, if this signal becomes invalid, it has to break the market structure here at these prices. So of course we could choose something like this. Okay, so of course, placing the stop loss, if structure fails, signal becomes invalid, stop placement at structural failure level. So we need this trade to reverse. Evidently, the market starts to trade up, so we get a very bullish, strong bullish trend line forming. And what you could simply say to yourself, guys, now this is again hypothetical, because I know from professional trading, a lot of professionals, when they capture a trend like this, you know, the 1, 2, 3, 4, when they see something like this, they say, well, look, I'm simply not going to get out of this trade until I see perhaps 2 bearish candles in a row or something significant to tell me the market's reversing. Okay, so that's how you could manage this position. Again, it depends on your own level of analysis. What unfolds? Well, the trend confirmed with the bullish move to the upside, of course. Only get out of trend, we could say, when reversal signal is confirmed. So does that make sense, guys? If you're looking to only enter the markets because you see a structural failure to, in this case, the upside, so you're looking to get long the market, why would you exit that trade unless you see the same thing? So your entry strategy or your exit strategy is effectively the same thing. And that's kind of what you see here. Now, we're not privy to it just yet. We see the price just settle and around price consolidation. What I'd like to say on a personal note is, well, what did we discuss just before this? We discussed historical context, guys. Historical context. And the last time this was trading up here is around parity, all the way back when, maybe a couple of years ago, 2 years ago. And now we have this trading, the dollar Swiss trading the parity once again. We touch parity levels here at these new highs. So we're effectively trading at parity. So one versus one. 1 US dollar equals 1 Swiss franc. So we're not privy to price action. Again, this is why I chose this market. I don't want to always give you examples where we're saying, well, this is a winner. Of course, it's great to show this as a winner. This is how we would trade this market. No, but what would be significant for us in terms of placing our stop loss? We could look to place our stop loss again, perhaps at these levels, perhaps a break from this low, or we could look to sell the market, a break from this low if we're not in the position, or adversely, we could look to actually add some more capital to this trade and effectively look to buy the market if parity is broken, because that is our long-term historical context point. So you can see how I'm just adding all of this context, all of what I'm just simply looking at. I'm trading what I'm seeing, not what I think, to expose many different opportunities that may exist in the market. Now, there might be winners, there might be losers. We're not privy to that, but we trade what we see in terms of the price action. So let's move across to many more different trade setups. What we have here in front is, of course, the German DAX. Okay, great. So an equity index, something completely different. How many signals do I need to define a trend? And again, this is a bit more hypothetical discussion in terms of defining the trend. But again, we're just trading what we see, guys. So it doesn't matter where you like to enter this market. Of course, Now that we know the market's relatively up at 12,942, well, the answer is, of course, well, I want to buy it at the best price, which would be the lowest price, of course, with this market. But I'm talking technically here, guys. How do we look to trade this price action? How many signals do I need to define a trend here? And does the market reject bearish sentiment? The answer for me is both. So I'll just let this chart resonate with you guys for maybe 10 seconds. If you can spot a few moments in time here where you either would like to buy the market or you would like to attach some sentiment to this market, definitely rejecting bearish sentiment, or perhaps you don't agree. Where can you see this chart some good opportunities, whether in terms of getting long or just providing signals? So I'll just highlight them here on chart here. What we have is some very, very significant rejection candlesticks. And again, simply looking to trade the price action here, there are a quantitative 7 of these candlesticks. And the truth is, guys, it doesn't matter where it really doesn't matter where you think the best price is. As long as you're applying the technical analysis, you're going to be able to profit in these markets. So let's just take this chart in time. If I take signal, obviously it depends on the duration of your trade, but if you take signal, let's just work with 2 trades here, signal number 3 or signal number 4, and of course then you'll be right. Perhaps you might not forgo that. Perhaps you want some more confirmation and you actually get some continuation. In terms of that confirmation, you could say that this is the signal that you want, because you have the rejection signal with 3 and 4, you have the market structure here within this environment where it's suggesting it's rejecting lows, and you get the market opening up. So okay, let's just say this candlestick right here is the best candlestick to buy this market at. Evidently the market trades to the upside, and that's great. We get, we can hold it to here, we could hold it to here for a whopper winner, for a fantastic winner, but we're not necessarily privy to that, of course. I would argue actually that the best setup is potentially this technical setup here, number 6, because, well, we get this market trading strongly to the upside, then it looks just to pull back. So we're actually trading an equity index that's showing performance to the upside. It's the candlestick itself that gives us that very, very good risk reward trading opportunity. Why? Because we can look to follow momentum if it occurs. So we can look to perhaps buy this candlestick if we get a break of the high around here at this price. I'll just color that in a little more there, and of course put the stop loss here below the low of this candlestick. So it gives us a good risk reward, and again we could look to hold this to the upside. Again, we get a confirmation that this trend is continuing, and again with this candlestick, and again with all these candlesticks, guys, we're seeing the rejection to the downside. So very, very easy technical trading there as well, simply by trading what you see, guys, and not having a preference or a bias at all. So does that make sense? Hope that conforms to your own ideals of looking at price action. That's what we see. Obviously very strong trends to the upside, and if I can understand then this, if I can understand this, when is the best time to enter the market? And again, that's totally hypothetical, because you could have entered at 3, 4, 5, 6, 7, any of these points in time, again based on this technical analysis, or just simply looking to trade this price action for some very good trades. So quite simple. Let's move across then to the euro pound, and again, when is the best time to enter this market? Okay, well, for this one specific trade, I'm just going to take a view that I want to be long this market. Why? Because, well, it's simply how I prefer to look at the price action. Now, the question I would like to pose is, well, should we buy here? I want to be long this market. Should I buy the market at this price? And I would argue, well, as a price action specialist, of course, that's really not the best price you're looking for, because it's not the best technical inclination that the market is going to continue to the upside. In fact, it shows quite the opposite. We've seen 3 reversals here from sort of momentum. So we've seen, trends, short-term, very short-term trends to the downside. We've seen a couple of rollovers as well, and a more relative one as well. So perhaps if I'm trying to get long, I want to get long a better price, and that makes sense. You want to buy something cheaper, of course, if you think it's going up. Now, try not to involve that intrinsic value there, but just think of the technical setup. And again, it's whatever presents itself. So Should we buy at this price, or should we be patient and wait for the technical setup to arrive if you want to get long euro pound? That's really the hypothetical discussion, but I would argue most certainly we should wait for the technical setup. Now you may get something a little more consistent in terms of seeing this as a level and seeing a break of this level and close above this level. That might give you the signal to get long, to follow momentum to the upside. But again, just looking at what you see, observing what you see in this market, it might not happen, but if it does and the market rolls down here, gives you the same signal here again with a little bullish candle right here, well, that is a big tick for us. That is a big tick to follow this momentum to the upside. And guys, these exist all the time, these trades. There are, well, right here in this chart in front, there are several of these trades. You might have missed the first one, of course. It's the first turn from relative lows, of course, but the fact that it does it on this third time, that is necessarily a signal, of course, to buy. You could look to buy a break of this candlestick right here from the high. Okay, so very significant in terms of the technical analysis. Again, trading what you see, not what you think. Question I would like to pose here when we look at Amazon here is, are there certain markets or asset classes that are technically easier to trade? What do we think, guys? Do we think that there are different asset classes that are technically much more adherent to price action trading? I would argue certainly there is, and it depends on what times the market open and close at, depends on the volatility, depends on the formation of the market structures as well, and how they're priced. So there's a lot of factors going into this, but this is what we can see here on screen. Of course, Amazon is an equity in the US. It opens according to the equity opening hours, of course, not like the futures market, which is open more. Of course, it'll trade a reflection of those overall prices, but the fact that it's open more, it means there's more liquidity. It won't gap and have less inconsistency. So that's what we see here. We see market gaps, we see inconsistent structures, we see no clear trend. It's difficult to trade. Okay, it's more difficult to trade just if you're focusing your skills on price action trading. Okay, so know that there are certain assets at times that are really giving you easier trades. There are easier trades out there in the markets, and that's what I like to focus on, to be quite honest. I like to pick medium risk trades, I suppose, that actually offer great opportunities but aren't necessarily the most difficult markets to trade out there and provide good technical setups. That's what I like to focus on personally. So let's move across then, and what we're going to do now is start to gather a full picture of what we're doing here. We're going to combine the skills, okay? Historical context and price action. Why might that be the case? Well, again, I know we're not going into too much difficulty in terms of technical indication and using different indicators on the platform, but nevertheless, the lesson is the same. When you're a technical trader, you're looking to stack the odds in your favor. You're looking for the highest probability setup. So if we can get some more context to the trade that's supportive of the trade decision, well, that's what we're going to do. So what do we see here in historical context? We have the Australian US dollar. So, well, of course, we have long-term highs, albeit there's some spikes above those levels. So perhaps if I was to just reanalyze this chart, I could say, of course, that these highs here are our long-term highs. That's more reflective of the real highs in the market, actually. But for sake of discussion right now, we'll just use these relative highs and lows here. Now we see the low there in the market actually breaks to the downside. So again, it's not necessarily a support and resistance trade. We are looking to not simply buy the market at that level, because that's we need, there's no technical analysis in that. We're aware of the level, but we need to combine the skills employed. Okay, so how do we do that? Let's really focus in on, I'll just highlight this on the chart. What we're going to do is focus in on trading this market in the relative price action right here at this point in time now. Okay, let's delve into the Aussie Australian dollar right at that moment in time. Here we are. Here is our historical context point right there around just below the 74.50 mark, I believe. And let's, or sorry, 74.60 mark. Let's focus in on what we see, not what we think. Okay, again, let's just take a seat back and really breathe, take in this trade, and we'll just look to trade this together. Okay, so what do we see? And it's good because this is more recent price action. The most recent candlestick there today is of course today's candlestick, today's price action candlestick. So what we can look to do is trade this together. What we see is a bearish trend to the downside. The trend trades the whole way down to our historical context point of reference, and then we see a bit of price consolidation there. Okay, a bit of price consolidation today. We see the bearish break, but this is the bullish hanging man. What does that suggest to us? Well, it suggests there's a rejection of the low. Is it significant? Absolutely, it's significant because it's right at our historical context point. Then we see the bullish engulfing candlestick. Now, again, to consult way back at the start of the Become a Pro, what does that mean exactly, the engulfing bullish candlestick? Well, it simply means that this is outdoing the whole context of this candlestick here. So although this was a bearish break of our historical context point, the fact that it is completely reversed in that candlestick and we get continued movement here and here, is that significant for us? As traders that we're looking to trade what we see, is that significant for us? I would say it absolutely is. Where does this candlestick close? And is there a trend reversal in sight? So again, we're not privy to that. But if I was to recommend a trade today, just based off the technical analysis, I would say this is our signal now. I'd like to see maybe a close in around this height. I'll just color this in for illustration purposes. I would say that is our signal there, of course, but we're not privy to that price action again as this market trades. We're still closing above the level again. So just as a pure technical price action specialist, that gives me support for a trade. So I look to go long this market at this given price, and again I could place my stop loss in and around, depending on the structure of the trade. If it's a long-term trade, I would choose maybe the low of this candle here, just to try and follow momentum way up to the upside again. Okay, that could be the case, but again, it's substantial enough just given what we're seeing in the price action. Again, this is simply what is the price, guys. It's all these market participants are getting involved. All these market participants are trading what they see as well, and many of them are proved wrong, many are proved right. That's why we focus as price action specialists to trading what we see in front. So already we're combining the skills of the historical context with this market in front. Let's move on then to looking at another chart here. We'll use something quite interesting indeed, again quite relative to us. I want to show you guys that of course this is a difficult enough pursuit that you're trying to stack the odds in your favor. You're trying to increase your probability, but of course there's going to be times when everything adds up and you're going to be wrong. That's absolutely fine, and this is one example of this, and it's quite relative to our own example here. What are we doing again? We're combining the skills of historical context points, again as technical analysis would suggest, and we're looking at the price action, simply looking to trade the price action. Okay, so what we see in front is the US Canadian dollar. We see a long-term high there, a relative high, sorry, at 130.19, and then we see more recent highs there in around our I'd say 128 level there, more conservative. Okay, but that's effectively something that we can look at. We can say, well, this is a support level in the market, holding the market up at some point. Okay, now what is significant is, well, even with all the analysis, the markets are often unforgiving. We know that. We simply trade what we see, and I wanted to bring this together, these combining the skills, to show you, of course, one winner, show you lots of price action trades, lots of good technical analysis, but to show you one that doesn't conform, and you're going to get these trades. So don't panic. They're going to happen, and again, it's all about reacting objectively to the trade decision. So we've zoomed in on this market. Again, I'll just zoom out the US Canadian dollar. Zoomed in on the market, we can see the price action. Here's our historical context reference point. Again, what we would describe, and we can trade this trade together as we go through the market from low to high here. Well, we have a little bullish trend forming, and this is at a time, of course, when the US dollar is quite strong across the forex majors and minors. Inevitably, what happens is our old friend price consolidation. Now, this is quite significant for us, because it's quite an unfortunate trade. and I wanted to pick it apart. More often the level of price consolidation, or the more mature that price consolidation is, then when the breakout happens, it can be much more much more forcible, or moving quite strongly in that direction inevitably when it occurs. Now this is not the case. So what we can see the level of inconsistency that this market is showing us right here. So I don't think I should count them all, but we'll go from 1, 2, 3, 4. Let's say we have around 12 candlesticks there the whole way to the end here. Okay, so really inconsistency. Then effectively, when we get the consolidation breaking down, we get our buy signal. Okay, we get our buy signal. Now, one thing I would suggest, of course, it isn't the perfect buy signal, simply because we get a level of rejection from the high to the close. Okay, so as long as that's understood, it's still a buy signal, though. The market trades up and closes quite a bit away from the price consolidation, and of course we're looking to follow the momentum to the upside if it's going to assertively continue. However, we get a rejection of that candlestick, and effectively we get a false breakout into our range again, and the trend is now in a reversal. Okay, so we've used the historical context point, we've used reading the price action as we see fit, simply reacting to what we see on screen, on the chart, forgetting about the fundamental analysis of the dollar. We know it's moving strongly to the upside, or showing strength or appreciation, of course, but we're just trading what we see. However, we take a loser. Inevitably, we take a loser on this trade. Now, that's fine. It's going to happen. But again, when I took some of those winner trades earlier, or discussed the technical setup, first thing I did was discuss where the stop loss is. The signal becomes invalid if we're looking to buy this market from the break. Here, we of course place our stop loss in and around our invalid signal. Maybe here, if we're looking for a long-term trend, it depends on the term of your trade, of course. But effectively, the market reverses and shows us a false breakout and moves to the downside. So it's fine. It's a really tough trade to take. You're going to stomach a very well-informed technical trade, both on the historical context point and on the price action reading. However, the market reverses. So take that into account, factor that into your trading, and again, this is the level of objectivity in placing your stop losses, your monetary exposure. You see how I'm starting to build all of these lessons in together to develop your idea about trading these markets more consistently. So let's move on then. We've discussed not only the historical context points over many markets, we then went forward to go through maybe 10 different markets and actually placing price action trades, walking through the life of that trade and the market structure. Now we've combined the skills together and effectively taken some winners and losers. Now what we see is, well, we can make some technical assumptions as well. And it's fine to make some assumptions in the markets. And again, if they're supporting your trade decision, again, what you do is you reactively place your stop losses when, if your own signal becomes invalid. So I've used this as an example. We have a few here. The assumption here is, after breaking a key psychological level, Bitcoin does not want to trade below $10,000. Bitcoin does not want to trade below 10,000 US dollars after breaking such a level. So that's simple. That's a simple assumption. But what do we do as technical traders? We trade what we see. Okay, so here is our effective break of the level with a lot of volatility in this candlestick. Again, for a moment, if we forget that this is the Bitcoin market, that we're simply looking to trade the candlesticks, then we get something a little less consistent here. But again, the market actually ends up closing just below the level, so it rejects lows, albeit it's bearish. Now this candlestick here is our signal where our assumption is correct. Okay, so we see the volatility, we see it break $10,000. We see the rhetoric around Bitcoin and the phenomenon that it was, of course. This candlestick here is our key. This is the candlestick that we say, well, we've seen the volatility laxed over the last 2 days. These are daily price charts, of course. This is our signal to buy this candlestick, perhaps the high of this candlestick again. The market shows some volatility again, but nothing in terms of a price structure, and we're up and away. So that's a complete technical trade. If you do forget for a moment that this is Bitcoin, you can add this assumption. It's fine to make assumptions in the market as long as you place your stop loss, as long as you use your assumptions with your technical analysis and trade what you see, not what you think. So, inevitably this becomes quite a good trade. Now I'd like to move on because I'll take this with a bit of pinch of salt, because this is effectively the Bitcoin market, of course. But what is, how can we use this in terms of more relative price action? And of course, I wouldn't leave you with this assumption just in one market. How does the price action claim support your claim? Excuse me. How does the price action support your claim? Of course, it does in this environment. So what I've done is just to look at this market, because we had the Iran deal there, of course. We had the US participation in the Iran deal obviously be revoked there last week. We have the US oil market, WTI oil daily price action chart in front. Again, is there something similar we see here? Again, we can simply make an assumption. Guys, we've been waiting for oil to trade above $70 for quite some time. So our assumption is, after breaking a key psychological level, oil does not want to trade below $70 a barrel. Is that the case? We don't know if that's the case, of course. But what we're looking to do is follow our assumption levels, follow the price action. Again, if we're not in the trade, we have the total discretion to say, well, I'm not in a position, I'm under no stress. Let's see how the story unfolds. Then I'll make the best possible trade decision. So one thing I would suggest is, with all the volatility, with all that volatility in that one trading day right here, we have our signal. We have the market trading the whole way down from around $70 or just under, say 69. We'll just pick a point here, 69.90, I would say, trading down to around 67.50 here with the low of the candle, reversing the whole way back up to close, albeit I would say flat on the day. Yes, it's slightly bearish, but it is a complete hangman rejection candle. Okay, and it gives us a signal, well, this market tried to trade quite a bit lower. It does not want to do so. The next signal is, of course, this candlestick here, and that is supportive of our assumption, guys. So we've made an assumption, we've looked at the price action, and we haven't made a trade yet, so that's fine. So if our assumption holds weight, if it's how we'd like to trade this market, well, where would we like to trade or make our assumption? Well, I would argue we've had a bit of volatility, and again, this can often happen, or does often happen, when the market wants to price in some new news, relative news. Perhaps the best trade that we could say is, well, does the price action support the claim? I would say it does. This candlestick today, this is actually today's candlestick, just to say, well, why would we like to trade at this level? Well, because it meets our assumption. The technical analysis suggests our assumption holds weight. If we were to buy a break of this candlestick here, well, of course, we could put our stop loss in around this level here, or perhaps this low here. I would say low number 1, simply because, well, if it rolls over to the downside, our signal, our assumption is invalid, and that's not the trade we want to be in. Okay, so you're allowing yourself to have an idea on a market, which is fine, and I don't recommend that people just ignore their ideas or the inclinations, because you want to trade off how you feel in terms of your view on the market, but you can't simply do that just off your own gut feeling, I suppose. So we've looked at an assumption, we've made a choice, we've waited to the market to confirm technically how it's performing. Again, this isn't one or two traders, this is the world trading the price of oil, all of these market participants. And perhaps today we can make an assumption right at our relative level. We're just 76 cent over the barrel. We can say, well, look, we'll buy the market here at this price with a stop loss in and around this price. 70 is so significant, perhaps we can get a trade up to $75 relatively soon. That might be an assumption you'd like to make. So again, these two assumption trades were to enjoy a hypothetical contextual discussion on actually trading levels as well. But it does feed into what we've been studying during this lesson. So we've looked, at the historical context points or reference points, and with price data, historical price data. Again, a fundamental view of technical trading. You're foregoing everything you know about the news and how it affects assets, but you're looking to trade purely technical. Then we went into all that detail on price action trading, looking to trade the price action setups, not on one particular candlestick, never on one particular candlestick, but developing the overall story of how the market structure performs over a series of candlesticks. And now we're looking at some technical assumptions as well. So it builds in that's the point of this type of education, that you can take this away and factor that in yourself to your own ideas and assumptions with your own technical analysis. And again, what I'd like to hit home with is, well, trading the merits. We need to trade each trade on its merits. So even with all the analysis, we will at times be incorrect and must take every loser as it is. Again, that's why, of course, we use our stop losses in the markets. All we can do is subjectively think, well, this is a great technical setup. We apply a level of risk consciousness to it, and hopefully we'll make a good trade and follow the breakout, the trend, or even a short winner, whatever it may be. We must take every trade on its own individual merits and not as a result to what worked for us in the last winning trade. Absolutely, that's the case. So if we've seen an inverted hammer to the downside on a support level or historical context level, and we have a great winner, perhaps it's the greatest winner we've ever had, the next trade that comes around the corner that shows us something similar, and we don't make the trade yet, let's say it's a long trade off a support level, and the next few days are very small bearish candlesticks, should we simply look to make that trade again? Well, no, because it's not the same market, it's not the same trade. Each trade should be judged on its own merits. Okay. In choosing to trade price action only, we are choosing to ignore other fundamentals. Okay, and that's again our efficient market hypothesis. That is certainly the case. And we can combine price action skills with historical context and a large range of technical indication to trade development. And that is, of course, going to be the focus of our next two lessons, Tuesday's lesson and Wednesday's lesson this week in the Become a Pro course. Very, very constructive in terms of getting, it's going to be quite enjoyable, getting into the nitty gritty of technical analysis with technical indication. Okay, that's certainly the case, guys. We did go through a lot of fundamental discussion with sector analysis, with supply and demand, with efficient market analysis, and economic data. All of these things are fundamental discussion points, and they will make you a better trader. You'll know more about the markets in question that you trade. However, again, this is taking a bit of a back view on technical analysis, where you can develop the skills needed here. Hopefully down the line, develop your own hybrid approach to a market that you have some fundamental basis or knowledge on, and then incorporate your technical analysis, incorporate your price action trading skills, and so forth. So it's absolutely the case. Lesson summary, of course. Well, regardless whether the markets trade according to past price data, they represent areas of the market of technical significance. I mean, does anyone disagree with that? I see unanimously we have no's coming in there. Absolutely, absolutely regardless of what happens around those prices, do they represent technically significant areas in the market? I mean, absolutely. We only have to go back to any of the charts that we viewed during this lesson. We looked at gold, oil. We looked at the Aussie dollar with the US dollar. We looked at the Bitcoin. We looked at the Canadian dollar against the Aussie dollar. We looked at the euro pound. I mean, need I go on? Of course, it's certainly the case, and you'll see these across many different asset classes. Application is often discretionary in judgment and can be different from one trader to the next. That's again the case. I'd be lying to you if I said we don't use any discretion in the markets. Yes, in terms of technical trading, we try to take away a large level of discretion, but everyone's idea on historical points and the exact price you'd like to enter at will be different. Again, you just try and stack the odds in your favor. And for some reason at the top here, this went up. Technical analysis is much more than using popular technical indicators. Just to hit home before we go on to the technical indication, quite heavy with technical analysis 1 and 2 over the next 2 days. Trading is much more about knowing Fibonacci retracement, levels of support and resistance, volume, and perhaps Bollinger Bands, guys. Trading is so much more than that. You can use some of these popular indicators sometimes. I mean, of course they work better again when you're trying to gather an overall idea of a story. So let me take an example now. The US dollar is very strong at the moment, very, very strong indeed. Now it's been a bit soft from the open today, and on Friday it was soft as well, but over the last 3 weeks the US dollar has been very strong. Now, with an inverse correlation, gold is at an inflection point. If gold is to trade up, sometimes say over the next 2 days or week, gold trades up to its historical point there that we viewed on the chart. and the dollar is still continuing to show strength, should that be the trade, or could that be a very good fundamental or technical trade that we can use all of what we know about our price action setups, historical context? Perhaps we have the Bollinger Bands in there that's telling us that the standard deviation from the mean at that time is at a level of interest for us. That might give us the sell trade, and everything stacks up. Well, that's it's as simple as that, guys. But there's a lot of context to that trade that I've just suggested there. But 4 or 5 pieces of information, can simply give you the idea. You trade what you see, and you get involved, and not taking too much risk on one particular trade, and then you're away. Then your way to developing different trading strategies. So it's as simple as that. But look, we will be developing a lot of these techniques with the next few lessons this week on the Become a Pro course, of course, with really delving into the technical indicators themselves. So that brings us to the end of today's lesson. Congratulations, we are now finished webinar 9 of the Become a Pro course. So this brings us on to week 3 today. I do hope you enjoyed it. Look, if there's no questions for now, guys, and I'll let you go. Thank you very much for joining us here at Forex.Academy. Look, we look forward to lesson number 10, Technical Analysis 101 tomorrow. So I look forward to them the same time. From all of us here at Forex.Academy, thank you very much for joining us. We'll see you next time. Bye for now.